Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hira Dadia. We have thus Seth Freeman, CIRA CTP, MD at Birelli Advisory Services joining in. Welcome to the show, Seth, and always a pleasure to speak to you and
for
get
having
insight
me.
from you. Seth, my first question coming to you is, let's start off with the recent data that has come in with regards to where the US inflation goes. The kind of numbers that we've been talking about is something that we've not seen a 40-year high. What do you make of this? Because now that's a pressing point across economies.
Well, I think we have to look at the causes of the high inflation we've had, and also look at how at the very beginning, particular of COVID-19, we saw economies, really flatten out badly. Although there have been great recoveries in many countries, so it certainly is bad news in terms of anticipating more aggressive interest rate hikes, not just in the U.S., because a lot of the inflation is really partly driven by global commodities pressures it's a global phenomenon, not just here in the U.S. But we also have to look at other causes in terms of supply chain disruptions, which has made certain goods just where there's high demand, but not as much. We're seeing here in the US, for example, premiums put on cars because we're told the chips that are needed to build the cars are not available. And so I think we have to look at the different sectors that are causing the inflation reports, and also think about the ramifications over the next few years.
Right. So, in fact, if you see in terms of the commentary that we heard from Fed Chairman, clearly indicating that the economy is both healthy enough, however, in need of tighter monetary policy. What would this entail? Do you think we could see rate hikes faster than anticipated and the tapering of asset purchases also ahead of what the street was anticipating?
Well, we had been told that the Fed was not so prepared to move, and if they did, it might be towards the end of 2022. But it's quite clear from the messaging, and not only the fact that I think they're going to be doing both of those things more aggressively, but we're looking at having multiple interest rate hikes, I think, during 2022. The question is, how large will each one be, and whether they will truly impact inflation, and how it might also disrupt, I believe, the real estate markets here in the US as interest rates rise.
So, Seth, how many rate hikes are you forecasting in 2022 in the US?
Well, recently, I think we were looking at 3 is what the news consensus seems to be. The issue is the timing and how aggressive they might be.
Right. And overall, if you see, is it right to say it's really time for the US central bank to start removing some of the accommodation that has been given to the economy?
Well, they're going to be using that tool to also try to control inflation, and it's going to impact the money supply.
Right. And what's the kind of impact you see in terms of the short-term and long-term rates go? Because as we know, they've been buying bonds since the onset of the pandemic to ease the financial conditions and push down on the borrowing cost. So
Right.
from here on, once they are looking to tighten liquidity, what's the impact are we expecting?
Well, I think it's going to have the greatest impact on the real estate sector. We've seen enormous appreciation in real estate assets, and part of that has been the result of low borrowing costs, because and the lack of competing investment opportunities at higher returns. And what will happen is, I think that's where we're going to see the biggest crunch, because properties have been, in fact, I believe, artificially, or have had artificial valuation increases as a result of the lower cost of ownership. I think that'll be the impacts initially. People are here very concerned about food inflation. And one of the real questions is, will the rate hikes help reduce food prices? We're seeing across the board cost increases that consumers are facing. And that puts a lot of pressure on a lot of families.
Right. In consonance to this, how are you seeing the European markets react? Because clearly, yesterday's session also, if you go to see, we did see a slightly up move that came in with regards to European markets. How are you? Do you think there's a possibility that the European markets could struggle for direction?
No, I think that European markets are going to be facing exactly the same pressures, and they may actually take even more aggressive action to avoid problems and to respond to the competitiveness issues that might happen, especially with money flows. If our interest rates are relatively higher, that could really impact not only European countries, but also emerging markets.
And basis this, how do you think that the emerging market economies should actually react and prepare themselves on the back of the Fed policy tightening?
Well, we've seen before when interest rates rise that money flows to emerging markets slow down. Now, some countries, particularly India, has developed a much stronger domestic investment base, especially over the last 10 years. So that might help buffer what we may see is money coming out of countries, high growth countries like India. India has some interesting fundamentals, and it will be very interesting to see if part of the global dynamics is a continued shifting of money, partly out of China and into India. But in terms of planning, one of the key problems for emerging markets countries is the fact that oil prices are global. And we've seen a tremendous rapid increase in oil prices. And it's probably unlikely that oil prices will subside with higher interest rates.
Right. So with these developments, is it right to say that we could see a lot of capital outflows from emerging markets like India, one? And two, how big a currency depreciation should an emerging market look like?
Well, I remember, earlier cycles when the dollar got stronger and the India market really swooned, partly because of relative interest rates and just foreign investors, shifting their focus. I don't know if that's going to be as strong, or the impact of higher interest rates and dollar strength is going to have the same dynamics in this cycle that's coming up. I do think, though, that we should anticipate money flow differences. There's a huge difference, though, between, let's say, 12 years ago and now, and that's the growth of index funds. And so emerging markets that may not be doing as badly in relative terms get hurt if investors are sort of down on China because it's such a big piece of an emerging markets index fund. So it's kind of the downside is a function of, you could say, contamination because of country weightings in index funds.
Right. So in turn to this, if you have to talk about India as well, do you think, excuse me, the currency depreciation will be faster and the need to raise benchmark interest rates in India becomes higher as well from here on?
I can't project at this moment if it will be faster. I don't think it's going to be as abrupt as we've seen in previous cycles. I think it's also going to be very difficult politically to raise interest rates in India very aggressively. I think that would just be a very difficult political decision, especially coming out of COVID-19 and coronavirus.
Right. So amongst emerging markets, where do you see attractiveness in terms of investments?
Well, I've continued to be very bullish long-term on India, and I don't see that changing. Some of the other many of the other emerging markets countries are really doing very badly. Latin America is not doing very well, although to the extent that it's a beneficiary of some rising commodities prices, it's doing better. But probably India would be continues to be my favorite country. There's significant political overhang involving investing in China, for example, although arguably it's not an emerging market anymore. So again, I think that the real problem is whether you are, a country picker or you are an investor in index funds, and you're just really subject to exposure based on the indices. I also think this, I'm very happy to say that we were ahead of the curve in terms of promoting the integration, adopting ESG principles, investing in India and investing in emerging markets going back to early 2000s. The one thing that I think will be very interesting is to see to the extent that investors who are focused on ESG issues allocate money to emerging markets. There are some emerging markets companies that are rapidly becoming, global companies with multi-generational managers coming in who are trained globally, basically taking over uncles or grandpas or even dad's companies now, who have been trained. They have a really global outlook. So I see a lot of mid-cap companies, frankly, in a position to grow really rapidly because they can adopt, with the new generation coming in, they're going to adopt new management practices. So I think looking at demographics in terms of who the up and coming managers are, we used to talk about the demographic dividend of all the young consumers in India. I think now we're talking about that same group from 15 years ago who now have their MBAs, they have their engineering degrees and global experience, globalizing their family firms.
Right. So with all of this, the kind of transition that we've seen in the last 12 to 18 months, Seth, on the back of the impact of COVID, a lot of restructuring that has happened as well. You have a new variant that has already set in. How do you see the restructuring process in India, and taking into consideration what's happening? Do you think that will be troubled waters from here on?
It depends on the government response. I know that in India, like here, there's been a number of support mechanisms. One thing about the Indian insolvency environment and regulations is that they have been allowed to evolve and are continuing to evolve now to basically adapt and become more aligned with a U.S. Chapter 11 process. The key issue is to what extent companies have been allowed to stay on life support over the last few years. And as any kind of programs that might have helped them, or they don't get the burst of sales growth and so forth, or profitability because of rising costs, that could put some pressure in terms of distressed companies in India and here in the US.
Right. So, Seth, very lastly, from here on, what are the key aspects one should be monitoring over the next 12 to 18 months?
One of the toughest things is that it's hard because of the COVID-19 situation to have, I think, really great projections on not only where the economy is going to be, but also to some extent consumer behavior. We've seen a big shift during this period of time. For example, delivery services, people didn't want to go out. A lot of those companies have had big valuations. They've been very successful. Will those kinds of companies continue to be as hot as they are? If there's a going back to normal, will people return, or especially consumers, return back to sort of previous lifestyles? But on a more macro basis, I think we also have to look at unemployment rates and the availability of talent, because at least here in the US, and I think obviously the population in India is huge compared to here, but the same dynamics, if companies are growing and there's pressure to hire employees, recruit employees and retain employees, it's kind of hard to measure as an outside investor what that impact is or how hard that is. But I do think the availability of labor is going to be very important. At the same time, we're going to need to look at just pure cash flows. We've seen enormously high company valuations, and many of them are based on very aggressive future prospect expectations. And so I think just for portfolio investors, and see, the problem is this: there's a big disconnect between stock market gains and how great the economy is doing. And so we've had a lot of gains, and the question is, will the economy midterm keep up with the gains we've been seeing? You know, will this relative frothiness be manifested in economic growth?
Absolutely. So a lot of factors we need to watch out for. Thank you, Seth, so much for joining us on the show. It's always a pleasure to speak to you, get insights from you. Thank you. Stay safe and speak to you soon again.
Thank you very much. Have a nice day.
You too.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.